بسم الله الحمد لله والصلاة والسلام على رسول الله وعلى آله وأصحابه أجمعين فأعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Assalamu alaikum wa rahmatullahi wa barakatuh. It's a great pleasure to record this lecture once again, actually the third lecture, and I hope the two remaining lectures were amazing and understandable and comprehensive for you. And I do suggest, if you come across questions, you can freely ask your questions through the LMS or through WhatsApp. If you do have my number, you can receive my number from Tawhid Saib or the Dean of the Faculty, Ustaz Abdullah Sadiq Saib. In the previous two lectures, we wouldn't need to talk about the first one, where we discussed the capital budgeting, the working capital, and some other terms of the corporate finance definitions. But in regards to the previous lecture, the second lecture, we talked about goals of corporation or a company. We said that corporations do usually have two basic motives. The first motive could be the profit maximization. The organizations usually focus on short-term earnings. They usually try to have little earnings very quick. So the little earnings they have, the more happier they are. You think about companies which are having the same strategy, or you can have examples of countries closer to you. There could be companies which are doing so. So companies with profit maximization strategy or goal, they are actually having put the prices very high. They do not actually pay a lot of discretionary expenses. They do not invest, or they do not spend money on advertising, research and development, maintenance. So they actually do not pay for these expenses because they want short-term earnings very quick and very smooth. That is why the risk engaged to the profit maximization is very less. So the less risk they take, the more the less profit they gain. So that's how it works. The risk and return relationship is a positive relationship. The more risk increases, the more return increases. And the less risk you take, the less return you get. So that's how it works. So they focus on risk mitigation, and they do not actually want to have risk at all. They mitigate it, they reduce it by using different strategy. So they actually hedge it in one way or the other. Within this profit maximization, the pricing strategy usually is very much different. Actually, they want to maximize profits by doing what? By increasing the prices, right? Increasing the margins of the prices of the products they have. They actually sell them higher as compared to the organizations or corporations which are focusing on the wealth maximization, right? So in regards to the capacity of the planning that they have, or capacity building programs, you see they are spending very less than that as well. So they actually decrease those expenses which are developed on increasing the capacity of for example, the employees for the existing sales, and they are actually doing it for short-term sales forecast. So that's how it works. When we talk about the other part, the other goal, which is wealth maximization, actually this is the vice versa. In wealth maximization, the focus is on increasing the overall value of the business, right? So the focus is not on increasing the profits, but on the value of the business. How they do it, we will discuss it in detail. Actually, they try to reduce their prices. They try to do a lot of expenses on research, development, on, for example, maintenance in other parts, in order to create a good name of its company in the market, right? So and to have a value think about all those famous corporations. They are actually wealth oriented, which are adopting the strategy of wealth maximization. So they focus on long-term investments. They focus on long-term strategies, and the short-term profits, yes, they focus on, because if you have a long-term strategy in long-term investment, you reduce the prices and you get short-term profits. But in long run, what you do, you increase the value of the business, right? So they actually try to have a leadership position in the market. In order to get the value of the business increased and to have a higher share in the market, you do what? You do wealth maximization. So that's what has to be understood. I hope you are with me on this. And this is another point, that the universally accepted goal of a business entity has been to increase the wealth for the shareholders of the company, and that is why they are risk inherent. They are actually risk takers. They take risk. So the moment that they start taking risk, the moment they get more return. By actually risk taking, we do not mean that you take a risk without utilizing it, that this risk is proper or not, right? So it doesn't mean you are risk averse in that part. You want to take risk, but you actually forecast for a lot of return in the long run to increase the value of your business, right? And to have higher returns in the future. So to conclude this part, we said that wealth maximization focuses on increasing the value. It focuses on the long-term value of the business. It takes risk, and it actually gets the larger part of the market share in an organization. While the other part, profit maximization, focuses on the short-term earnings. They do actually want to have profits increased only, and they do not focus on the other part, which is the wealth maximization or value maximization of a business. We talked about the financial management. I think the basic thing was to manage the finance that you have in an organization, to do proper planning and proper organizing that, controlling that financial activities, and you also do proper administration of the for example, accounting, bookkeeping, and other parts which are part of the financials that you have. While in corporate finance, we focus on, for example, maximizing our profit by little spending, right? And we also focus on, for example, having the shareholders' wealth increased or maximized by having various strategies and by implementing various strategies in an organization. So that was what we have actually studied in the previous lectures. In today's lecture, we talked about corporate governance. Why we talk about it? Because corporate governance deals with the policies and the principles and the procedures which are clearly defining the responsibilities and accountabilities of stakeholders in order to eradicate the conflicts that are inherent or that are available in a corporation. So the importance of understanding this part, which is corporate governance, is in the understanding of different forms of business. And actually we had a very quick snapshot or quick review of the different forms of business, which were in another perspective. Today we will be discussing it in a very technical way of the corporation side. So the corporation actually, governance actually affects the operational risk. We will talk about operational risk later on, inshallah. We have a detailed slide on that. And it also affects the sustainability of the corporation in the future and in the present as well. The quality of the corporate governance affects the risk and value of the corporation that we are working on. If we have strong and effective corporate governance, we will be having efficient functioning or role in the market, right? Now, the objective and guiding principles for corporate governance are, for example, there are inherent conflicts of interest in corporations in which the ownership and management are made separate. You see, the management and the ownership in corporations should be actually separate, how it has to be dealt with. So the objective of corporate governance is actually to eliminate or to reduce the conflicts of interest that are taking place in an organization, particularly between the managers, shareholders, or board of directors, whatever, that are a part of a corporation, especially in the very top management part, a very high level. And we also study corporate governance in order to ensure that the assets that are within the organization are efficiently and properly or productively in the best interest of the investors and the stakeholders, right? That is why the core attributes and the core advantages for an effective corporate governance system could be, for example, we do fair and equitable treatment while dealing with people, either internally or externally, right? We focus on transparency, in accuracy, in disclosures of the terms and conditions that we have in the organization, or transparency even in the other processes that we have within the organization. We talk about proper and identifiable, measurable accountabilities within the organization, or to the other people in the organization if we do have proper corporate governance. The rights of shareholders and stakeholders would be properly given if we have a proper and effective corporate governance. The responsibilities of manager, shareholders, and board of directors would be identified if we have effective corporate governance. You see, so these are actually the advantages of having an effective corporate governance, that we do fair and equitable treatment. We actually focus on transparency transparency and accuracy. We focus on having measurable accountabilities given to others. We focus on a clear definition of the responsibilities for the director, for board of directors, for managers, or for shareholders. So this is how it works. I hope you are with me on this, and you clearly understand what we talk about. So this was اگر ما یک effective corporate governance داشته باشیم، باز این فایده که ما 5 نکته که ما شما صحبت کردیم این هم داشته می باشیم. Now, coming to forms of business and the conflicts of interest. You see, we have the form of business will actually dictate in part the relationship between the owners of business and management. The form of business that we are actually dealing with, either a sole proprietorship, either a corporation, or a partnership. This will show us the relationship between the owners of a business and the management. You see, when there is a separation between the owners and managers, so there would be a potential for agency problems that could take place in an organization or a corporation, and will in one way or the other affect the value of a business. We can examine these three forms, the sole proprietorship, partnership, and the corporation, in the coming slides. The first one, as we discussed, sole proprietorship. This business is operated by one man army, one person. One person is working on this. So this is actually the business which is practiced by a lot of people in each and every country. A lot of people are having small businesses. Sole proprietors are available. Now, the question raises, who is actually bearing the governance risk? The owner itself. The owner actually is governing the risk, because he's the only one guy who has to do this. And the creditors do have highest risk to the governance, because there is one guy who has to pay to the creditors, and which increases the risk of governance or their risk to have back their amount. So a partnership, as from the literal meaning, partners, like people become partners in something, sharik. More than one person, two or more than two people, that's becoming partnership. Now, who is sharing the governance risk? So the owners have the rights and responsibility, and this has to be within the agreement on the shoulders of the partners, right? So again, the creditors have high risk in respect to the governance in partnership as well. Now we're coming to the most important part. Corporation. Corporation is actually, or a company, is a legal entity that has rights similar to an individual, and that's a very technical definition. You see, it's a legal entity who is separately dealt from other people. We said in partnership, in sole proprietorship, people were actually the entities where we were dealing with. But in corporation, the corporation has a separate legal entity than an individual. It is similar to an individual, but it has its own legal entity, right? So, for example, the corporation itself can enter into contract, right? Because of its freedom. So, corporations account for most business revenue around the world. They get the businesses, the most famous ones that you think about, all those are corporations. For example, you think about Apple, you think about Samsung, you think about, for example, the other, Microsoft. All these are corporations which are earning bigger amount of cash or money. Okay, moving forward. So now the advantages, for example, a corporation itself can raise capital, right? If you have a corporation, you can raise capital. You can raise capital by either issuing stocks or shares, or you borrow from someone, or you issue bonds. We will be talking about it in later slides. You issue shares by inviting other people to buy your shares and be part of your business, or you issue bonds in order to allow people to buy your bonds, and you have the cash, and actually those people can sell back their shares or bonds to the other people. So that's how it's working. Owners do not need to run the business, actually, unlike the sole proprietorship and partnership. There, the owners have to manage and run their business, but in corporation, easy, you go easy on this. The corporation, actually, when it's not run by the business or the owners, it can be run by any expert, any professional who knows how to run a corporation. So that is why we say it's a separate legal entity. So the experts could be not the owners. It could be somebody who actually do not have a penny in the business, right? So these people can be the runner of the business, who actually are the experts, professionals. That's what the corporations are dealing with. And the ownership interests, or the ownership itself, can be transferred. You can sell your shares to other person, right? Now, like everything else, corporations do have disadvantages, right? To be honest, corporations are actually very much regulated entities. There are a lot of regulations, and you have to be binded to those regulations in order to establish a corporation, right? It's not like a piece of cake, you eat it, right? It's very hard to have a corporation. It's very hard to implement regulations, and I wouldn't say impossible. It's possible, but it's hard. So in the US, there are state laws pertaining to corporations, and the Securities and Exchange Commission requires specific disclosures. You see, there are disclosures, there are policies which are actually making you binded and making you fastened not to start. So you have to pay some securities to the government. You have to guarantee that you are doing what you are doing is right. So these are all those problems that could be raised while you try to initiate or start a corporation. The other thing that a corporation does is it separates the owners and managers. So there could be an agency relationship where the agent can act, for example, on behalf of the owner or a manager, but you see, these have to be separate. And the potential conflict that is raising between the owners and managers is actually the agency problem or the principal-agent problem. So principals are usually, when we talk about a principal, we talked about shareholder, and when we talked about an agent, we talked about management and members of the board, right? So shareholders are the principals, and the agents are the management and members of the board, because they are representing the organization, right? And principals are people who are actually having part in the business, who have one or two or three or four portions or shares in the business. Okay. Now talking about some of the major differences or characteristics. For example, in sole proprietorship, when we talk about ownership, the sole owner is the sole proprietor himself, right? And in partnership, there could be multiple owners. For example, 5, 10, 20, 30, 40, 50. But in corporation, there could be thousands of hundreds of ownership. For example, this would be amazing for you to say, for example, somebody from for example, let's say, as you know that Microsoft is an American company, somebody from Europe could have ownership in the Microsoft because he has shares or stocks in it. So you see, the ownership in the sole proprietorship is very limited to one person, in partnership limited to few people, while in corporation it's unlimited. There could be thousands, hundreds of owners in a corporation. The legal requirement and regulations in sole proprietorships are very easy, very simple, very little, and in partnership little hard as compared to sole proprietorship. But in corporation, believe me, there are a lot of legal requirements. There are numerous legal requirements, and they are not easy to follow. The legal distinction between an owner and in business, the owner in the business and the manager in a sole proprietorship or in partnership could be the same guy, right? One guy, owner and manager. But in corporation, there has to be legal separation between the owners in the business. That is why I said corporation is a separate legal entity, different from the owner, right? So, and that has to be well defined within the bylaws or the corporate governance of the same company or corporation. The liabilities. You see, sole proprietors can get unlimited liabilities, and which should be paid alone by the sole owner or the sole proprietor. In partnership, the same case. A lot of people, a huge amount of credit can be taken, but which has to be shared amongst the partners, the liability. But in corporation, it is limited because it's a separate legal entity. While raising capital, the sole proprietorship can raise a very limited, very limited or small amount of capital to be raised, and in partnership, that is compared as compared to the sole proprietorship a little more. While in corporation, it is like nearly to unlimited. They can take a lot of money unless it is discussed with the government, and the government and the legal entities know the limit. There could be a limit, but that is like nearly unlimited means a lot, right? So the transfer function in the sole proprietorship, that could not be transferred, right? The ownership could not be transferred unless the business is sold, right? The business is sold. One guy was Ahmad. He sold his business to Mahmoud, which means that the business is owned by Mahmoud now, right? Partnership, it is not transferable. You cannot transfer because there are a lot of people. One partner may sell his part to the other, but that is very much restricted. But in corporation, it is easily transferable. You can transfer your rights, you can transfer your shares to other guy. One guy says, I don't want, they'll say, okay, I will buy your part of share. So that's how it works. So the expertise in the business of the owner in sole proprietorship is necessary, mandatory, because if a sole proprietor does not know how to run a business, he wouldn't actually do that particular thing. While in the partnership, it is also important, but in corporation, that's not, یک نفر است که هیچ تحصیل نداره، هیچ تعلیم نداره، هیچ تحصیل کرده نیست و یک کارپوریشن شروع میکنه. به خاطر اینکه که او یک دیگه نفر هایر میکنه، ما گفتیم که اکسپرتس هایر میکنن، کسایی که مسلکی باشن و رو هایر میکنه، خودش از دور کنترل میکنه، خلاص میبینه و حسابی خود کلیر میکنه به اصطلاح. انشالله که این مسئله، این بخش بسیار مهم بود که با شما مواظب باشه و این را دقیق تر بخوانین که باز در امتحان هم شاید از این سوال شود. خب now we talk about the relationship, agency relationship, the relationship. If that is not kept in mind, if this chain of command is not kept in mind, what happens? A conflict will take place, right? So a major management shareholder conflict takes place when management directly, for example, approaches shareholders, right? Because there has to be board of directors in between them. Board of directors functions in between shareholders and managers, right? So there could be problems raising between board of directors and shareholders. I wouldn't say there wouldn't be, but usually the problems are raised between the managers and the shareholders due to not actually obeying the chain of command. Okay, now management shareholder conflicts are also, as we said, important. The shareholders actually entrust management with funds which are reinvested for earnings or newly issued stock which management invests. So the primary objective is to maximize shareholders' wealth. As we said, in the wealth maximization is a very important strategy for corporations to adopt. So maximizing shareholders' wealth is very important for the corporation. And we know that managers are humans, right? For example, some managers may be interested in expansion of the business, or for example, a business to be based on bonuses or earnings, a business which should take a lot of risks, a business which should have job security, right? That's the thing. Managers may be, for example, they may consume excessive prerequisites, or for example, they take the advantage of the position that they have. So now what's the bottom line? There may be agency costs in terms of explicit and implicit costs when managers do not act in the best interest of shareholders. You see, if managers are not properly functioning, there would be costs that they have to bear, right? So if there is effective corporate governance, to be honest, the agency costs, that would be actually guarded and that would be reduced. Now, director shareholder conflicts could also board of director. By director we mean the board of directors, or for example, we said that in this slide that are intermediaries between shareholders and managers, and they actually represent the shareholders' interest by, for example, how they represent the shareholders' interest by monitoring the managers, for example, by approving the strategies and policies that are showing that have to be part of the corporation, or for example, if a company is merging or joining with other company, combining with other company, that is also approved by the board of directors. The audit contracts, the internal or external audit contract. Usually, the external audit contracts are approved by the board of directors. Reviewing the contracts of audit, establishing compensations, or for example, performance, etc. These all things are the interests that have to be understood. So when does a conflict arise? For example, when the board of directors align with the management itself, which is a bigger problem. So the management should not align up with the board of directors, because board of directors do have separate responsibilities that they have to take part in, because they actually represent the management by performing these things. And if the management is interrupting their responsibilities, then what happens? A conflict will be arised. Okay, now what are the responsibilities of board of directors? For example, they establish corporate values and governance structure for the company. They ensure that all the legal regulatory requirements are met. And for example, they talk about long-term strategic objectives of the company. They actually establish them. They establish clear lines of responsibility and accountability of the performance measurement that is taking place. They have the responsibility to hire executive officer, or we call it CEO, in an organization. They determine the compensation package for each and every person, and they actually determine the performance of the people in the organization. And they tend to transfer. That they tend to understand that the management has supplied to them with sufficient information, which they have to be informed of, and they will monitor everything that takes place. And they do have regular meetings, in order to see the performance and see the duties are properly performed or not. And the training issue is also part of it. Now, corporate governance evaluation, the attributes and the key elements and the qualities that board of directors should have, or for example, they should be comprised of independent directors. For example, it means that these guys shouldn't be somebody from inside the organization. The chairman for the board, the head of the board, should be an independent person. Sometimes, usually, they hire the CEO as the chairman or somebody else. The board of directors should be qualified people, and they should be the result of the election that is taking place. There should be regular election between the board, for example, yearly or after 5 years. And there should be regular self-assessment of the board, the assessment or analyzation of their functions being performed or not, and they should hold separate meetings for the independent directors. The board should require audit oversight by independent directors who have sufficient expertise in finance. So you see that they should be liable to the audit as well. In the continuation of the previous slide, the committee that is nominated should be comprised of independent directors. The compensation committee should be comprised of independent directors. The board should be able to hire outside counsel. Yes, they have to have this authority as well. The board should disclose governance policies while needed. They should disclose it. The board should ensure adequate disclosure and transparency. The transparency should take place within the board, and they should respond to shareholders' non-binding proxy votes. It means that it shouldn't be like the board takes a decision and the decision is the final decision. You see, they have to communicate things with the shareholders. The ultimate decision is usually taken by the shareholder or the managers. The board usually takes a decision, votes for something, and they allow the managers to take the final decision and to implement it, right? So there should be non-binding proxy votes in order to implement whatever they actually tend to say. So some of the the principles of the Monetary Authority of Singapore that I have brought here for you. These are the guidelines and regulations for a corporate governance. These could be essential or of vital for you. For example, the first one is that every institute should be headed by an effective board. Each and every corporation should have a board of directors, right? And maybe you could say a board of shareholders as well. There should be a strong and independent element on the board which is able to exercise objective judgment on corporation affairs. It means that the board should be independent from the management and from the shareholders. It should take their decision independently. That shouldn't be convinced by the management or the shareholders' decisions. The board should set and enforce clear lines of responsibility attributed to the institute. Yes, it means that they should have their own responsibilities, and they should set actually responsibilities and accountabilities to the whole institution or corporation they're working. While you are hiring board of directors, there should be a transparent process. یک پروسه به اصطلاح پاک و شفاف باید باشه تا که board of director رو ما منتخب میکنیم. There should be a formal assessment of the effectiveness of the board. یعنی یک اسسمنت باید باشه که تا که ما ببینیم که هر نفر چقدر اهمیت و چقدر رول داره، افادت داره در وجودشان در خود بورد. Board members should be provided with completed with timely information. معلومات باید برش به وقت داده شود و بورد که مثلا چی کارهایی که با دفتر و در کارپوریشن انجام شده و معلومات باید دقیق برشان بدن تا که و پیش از میتینگ تا که و با اساسی او باز تصامیم خود بگیرن. The principle number 7, while you are fixing the salaries and remuneration packages, the board actually should do that. The management or the director, if they are involved even, the simple philosophy of this is that when the salaries for the board of directors, the people who are part of the board of directors are available, the salaries should be, for example, fixed by, for example, the management, right? The directors should not say that you will have to pay me this amount. So there is a salary indicated for all board of directors, and they take it based on that. شما اگر ببینین ما در یگان جایی از این تجربه دارم در خصوصا در بانک‌ها در بورد آف دایرکتورها و من از یگان جایا یا بورد آف سوپرویژن هم برای شما نوا میگن از کشورهای مختلف می باشن از اونجا میاین و پر میتینگ و پیسه خود میگیرن دیگه او یک چیزی دیفاین کردگی از اول می باشن. اگر ما شما به شکل رسمی با یک ارگانیزیشن یک بورد آف دایرکتور جور میکنیم تو نمیشه که یک ممبر بورد بگه که با ما قدر معاش بدی او معاش فیکس میشه و تو نمیشه که individually او تریت شه. هدفش چی است؟ The level and composition of remuneration should be appropriate to attract، یعنی معاشش مناسب باشه تا که او را دوباره تشویق کنه و کار خود پیش ببره. اینطور نباشه که او حق نداره و باز سرشان ظلم شه. اینطور نباشه. The board should establish an audit committee with a set of written terms and reference clearly sets out its authority. یعنی audit باشه که صلاحیت واره و مسئولیت‌های واره و کارهایی که باید انجام بده او را بررسی بکنه و برایشان معلوم بده که این کارهایی باید شما. The board should ensure that there is an adequate risk management system and sound. یعنی یک کنترل و یک چی هست که همو ریسک و چیزایش مد نظر میگیرن. سلاید آخری که ما شما امروز میخوانیم این در مورد 3 اصول آخریش امی بورد است با کارپورت گورننس است میبخشین. Megan, the board should ensure that the internal audit function that is independent of the activity audit is established. There should be internal audit in the organization. Each and every organization have their own internal audit system. The board should ensure that the management formulates policies to ensure dealings with the public, the institutions, policyholders, and clients, depositors, and other customers are conducted fairly. یعنی امو پالیسی و پروسیجرها که با مردم عام جور میشه، با کسایی که امرایشان نمی کمپانی کار میکنه، کستومرها دیگراست، امو پالیسی که هست او به شکل پروفشنال مسلکی و به شکل مسئولانه جور شده. و the last principle is that the board should ensure that the related party transactions with institutions are made on an arm's length basis. It means that on a proper basis. و یک معنایش دیگه ای است که وقتی که کدام معامله مالی صورت میگیره او باید مستقلانه گرفته شده باشه، سر یک پارتی فشار نامده باشه، هر دو پارتیشان به اصطلاح موچول اگریمنت داشته باشه، زیر فشار نامده باشه و یا کدام دیگه معامله نداشته باشه که او در کارپوریشن این صورت گرفتن هم خودش به conflict of interest lead میکنه. So this was our third lecture. We covered most part of the topic of corporate governance, the definition, the attributes, the qualities that a corporate governance should have, the forms of the business, their differences. Specifically, we discussed about corporation, the advantages and the disadvantages. We talked about some of the characteristics that all three types of forms of business have. We talked about the conflicts that are arising, and we also talked about some of the principles for the corporate governance and for the board of directors that we have. So this was all for today, and inshallah in the coming class we will finish this part and we will try to start the other topic, which we will be talking about the hypothetical organizational chart, which is related to this, how the organization chart works. And then in the next classes we will go and have a very quick review of the income statement and balance sheet, and then we will start going towards bond valuation and capital budgeting techniques and etc. Thank you for watching and listening to this lecture number 3, and inshallah I will be available for your queries and questions, and jazakumullahu khairan. Wassalamu alaikum wa rahmatullahi wa barakatuh.